All right, let's go ahead and get started. Today is Monday, February 28th, 2 p.m. section. This class is being recorded. This is the sign-in sheet. Make sure you sign this for today. So, most of what we're going to cover today is going through the ROIC tree CFI analysis, which will be your next two homework assignments, as well as your next group project as the second section of our class. So we'll pick up where we started last Wednesday, ROIC tree CFI. This is the historical analysis of a company. But before we do, I wanted to do a quick check-in on the Bloomberg Trading Challenge. Here is your section. Good news, everybody is below $300,000 in available cash, and everyone has made the requisite 10 minimum longs for the first half of the semester. So we actually see a team very far ahead. After the two-thirds mark, we basically finished this first half on March 13th. Anything they want to brag about? I guess they don't want to give out their secrets for why they're in first place. Okay. Did everybody make money on Tesla last week? No? No one did? I bet somebody did. I think they were up like, what, 15% on Thursday? And then another couple percent on Friday. So we talked about that. Did I say Tesla or NVIDIA?
NVIDIA. Or you said Tesla.
I meant to say NVIDIA.
Yeah.
Did you make money on NVIDIA last week?
Yeah.
Sorry.
I was going to say, that's...
Yeah, not Tesla, NVIDIA. Anyhow. All right, questions about the trading challenge? All right, so just upcoming logistics. We will not be having class on Wednesday. None of the sections will. I will not be here. So no class on Wednesday. Next week, you'll have two homework assignments, one which is due on Monday, the other is going to be on Wednesday of next week. Those are the two next to CFI ROIC trees. I will give the company out later today for both assignments. I'll give you the converted data, the ROIC trees and the CFIs. You'll have to analyze both 500-word papers individually, minimum, and then basically those are your next two homework assignments, right? Also, coming up next Wednesday is the midterm exam. Okay, it's fast approaching. So the midterm exam will be a open book, open notes exam, individual. It'll be 10 multiple choice questions. Every question, including an answer that says none of the above. Okay? And it will cover anything that is in the book, any of the readings, right? Anything in the PowerPoints, and anything that we talk about in class. It's theory. So you don't have to crunch a bunch of numbers, don't have to look up Bloomberg, but it's, do you understand what we have been talking about conceptually, right? And one of the questions, or one of the answers for every question will be none of the above, okay? So just giving you an FYI on that one, okay? So that exam, yes?
Let's say, is it pen and paper or is it on the computer?
It'll be on Elms, electronic. The exam will open up at the start of your section. So in your case, it'll open up at 2 p.m. and it will close 90 minutes later at 3:30. Okay, and you must take the exam during that period of time. Okay, you'll be taking it through Elms. Now, technically, you can take it anywhere that you can access the internet, so you don't have to physically be in this room to take the exam. You want to take it in your dorm room, that's fine. You just need Wi-Fi access to Elms. Okay, and so again, no collaboration. You're subject to the honor code, but basically you'll take the exam, and the nice thing about it is at the end of the day, you'll see your score, because Elms will auto-grade the multiple choice exam. Okay, so that will be next Wednesday. Okay? So again, you don't have to be here to take the exam. You can take it anywhere, but you got to take it during the class time you're registered for. The exception to that would be anybody with either an ADS accommodation, okay, or somebody pre-approved something with me. So for example, I have somebody that's traveling with the Maryland basketball team as part of the tournament, so they can't be here next Wednesday. So they're going to be able to take the exam at a different time, right? If you fall into those exceptions, which would have had to be pre-approved by me, okay, there'll be an exam link called the alternative midterm exam, right? They're both the exact same exam. The difference is timing, okay? For everyone not getting an accommodation that's pre-approved, you have to take the exam during your class time, and you have to finish within 90 minutes, right? For people that have more than 90 minutes of time or can't take it during class time that have been pre-approved, they can take the alternative exam. The only difference is the alternative exam doesn't have a timer on it, and they're just subject to their accommodation, whatever it is, okay? So don't take the alternative exam, all right? If you take the alternative exam, you're not registered for it, bad things are gonna happen to your grade. So don't do that. All right. Questions about the midterm? Hopefully pretty straightforward. Okay. As we go through class today, I'll give you some examples of what might be there, because the last class was actually helping me write the exam in real time with the questions that they didn't seem to understand. All right, so let's start talking about the historical analysis. So I'm going to go back to lecture note 2. So on Wednesday, we were talking about Starbucks ROIC tree. Go back and cover some of this. Sorry, I can't make it full screen. It actually kills the video recording. All right. So, as we talked about last week, we're going to analyze a 5-year historical ROIC tree for a company. Very important, you use numbers. Without using numbers, you won't get a good grade at all. Follow the process that I'm going to give you, kind of going from left to right. Make sure you cover every item on the tree. And even though you're kind of starting out with the beginning and the end, the middle matters as well. And real world context will be very important, particularly when you get to your group projects. Okay? Because in March 13th, you're also going to be doing a 10-minute group project presentation on this verbally. So 2 individual papers, then the group project presentation. All right, so back to what we talked about last week. EOY stands for end of year ROIC, current year no plat divided by current year invested capital. So 5-year change, Starbucks went from 48.3 to 23.2. That was a 51.9% drop. Okay. They basically bottomed out at 7% in 2020 before rebounding to 23.2, but still much lower over the 5 years. Why? 3 reasons, always 3 reasons for a change in ROIC. Reason number 1, cash tax rate. Okay. Tax rate went from 33 to 22 over the 5 years. All right. And so it's very important that you not only identify the numbers, but you also talk about the impact on ROIC. That should have helped the ROIC over the 5 years. So that's not why the ROIC fell at Starbucks. But I still have to identify the driver and the connection to the impact of the driver above. Next, taking out the impact of taxes, we had the pre-tax ROIC, which fell from 72.3 to 29.6 over the 5 years. Again, precipitous drop in 2020 when it hit 8.8 before rebounding to 29.6 in 2021. That was a 59% change over the 5 years downward. Okay, so the real reason the after-tax ROIC went down is because the pre-tax ROIC went down. Why did the pre-tax ROIC go down? Drivers 2 and 3. Driver number 2 is operating margin. Driver number 3, invested capital to sales. Okay. Now, operating margin is basically how much you make when you sell something, right? Higher being more profitable and better to ROIC. So in 2017, Starbucks operating margin was 18.5%. By 2021, it fell to 16.8%. That was a 9.2 percentage point drop, right? So they're making less on every sale, which is a reason that the pre-tax ROIC went down. Driver number 3, invested capital to sales. Okay. Now, I want to talk about the relationships between drivers number 2 and 3. Okay. And this is where algebra can be instructive. Driver number 2, also known as operating margin, is profit divided by sales or revenue. I'll represent as P over S. ROIC is profit divided by invested capital. So the point is, the numerator is the same for both, but the denominator is different. Right? One's representing P over S, profit over sales, that's your operating margin. Two is profit over investment, that's ROIC. Okay? So then the question is, how do we get from P over S to P over IC? Well, that's where algebra comes in. If I multiply P over S times something over something, that will equal P over IC. Does anybody remember their algebra? What would they blank over blank be? P over S times blank over blank equals P over IC. Yeah.
S over IC?
Has to be S over IC. The S's would cancel out, and you'd be left with P over IC. Thank you for that assist there. But that is instructive, because this multiplication sign tells us P over S and S over IC have equal weight in explaining ROIC. So there's two things that drive ROIC. By the way, that's number 2 and 3 on this page. Okay? So number 2, operating margin, times number 3, invested capital over sales, equals ROIC. So those are the two things that drive ROIC. Will work for any company always. That's the math. Okay? And that's the other point, equal weight. Right? Now don't get me wrong, if you lose money, it doesn't matter what your productivity is. You'll never generate a positive return. So it's assuming you make money, but obviously equal weight. The other thing that's important here is that on this ROIC tree, I'm using the reciprocal. Okay? It's not S over IC, I'm using IC over S. Right? And you might be saying, why is he doing that? Two answers, but number one is, when we get to the second level driver of the balance sheet, we're going to add those three things up to be the level above. That's one of the reasons. And so it just makes it more consistent throughout the tree. Everything's based on dollars of sales. The other reason is that even though investors think about return on investment, companies don't. Companies think about it in terms of revenue, right? How much did I make when I sell something, right? How much did I have to spend to sell it? Everything's based on sales. So we're taking more of a corporate view here of the ROIC tree, what cash you're generating, okay? And so therefore, we're going to put everything in per dollar of sales, per dollar of revenue. Okay? That's the way this tree is structured. But it also lets us add across the tree, right? So back to this. Invested capital to sales is a reciprocal. So operating margin times 1 over that equals pre-tax ROIC. But here's the deal. IC to sales lowers better, okay? So that's the point. In 2017, Starbucks was spending 25.5 cents per dollar of investment to generate a dollar of sales. In 2021, they're spending 56.6 cents of dollars of investment to generate a dollar of sales. So they're clearly spending a whole lot more, 122% more, to generate the same sales. Okay? So if I really want to understand why the pre-tax ROIC is going down, it's both of those, but driver number 3 is having a much more outsized impact than driver number 2. That's what I need to say in my first level of analysis, using numbers, walking through, talking about all 3 of those every time, whether or not it's changing, if it's changing, how it is impacting the overall ROIC above. Questions about the first level analysis? Once you complete this, you'll move to the second level analysis. Why is the operating margin changing? Why did it go from 18.5 to 16.8? First, gross margin. Gross margin went from 35 to 34. That's a 1.2 points drop in gross margin. So it's a big contributor to the drop in the operating margin. SG&A went from 13.8 to 13.4. Now that was slightly favorable, but it was favorable by 0.004. So not much of a change in SG&A spending. Depreciation went from 4.8 to 5.2. Again, slightly unfavorable, but 0.004 unfavorable. The SG&A favorability and the depreciation unfavorability kind of cancel each other out. So the real reason the operating margin fell was the drop in the gross margin. That's what I mean by second level drivers. You got to talk about all 3 and what the final impacts are. Questions about that? We then move on to the balance sheet. Operating working capital went from negative 5 cents to negative 7.5 cents. We talked about last week how negative working capital lowers your investment. That's favorable. PP&E to sales went from 22 to 50. That's the big jump of spending. They're basically spending 129% more. And intangibles went from 9 to 14. Okay, that actually was a little bit unfavorable too to the productivity. But the headline is PP&E to sales. They're spending more than twice as much to generate $1 of sales on their PP&E. Okay, that was the drop in productivity. Once you've covered all of that, second level analysis, you summarize from right to left. Summarizing, a big increase in PP&E to sales from 22 to 50 was the primary reason the invested capital worsened from 25.5 to 56.6, which is the primary reason that the pre-tax ROIC fell from 72 to 29.6, although it was also hurt by a slight drop in gross margin from 35 to 34, which did hurt the operating margin by 9%. And that led with a lowering of taxes, which should have helped them a little bit, 33 to 22, but not enough to offset the drive of end-of-year ROIC going from 48 to 23. Cover every item, go from right to left, then summarize left to right. That's at least 250 words. Use numbers along the way. Don't go out of order. Questions? By the way, when you're doing this for your group project in a couple of weeks, I would recommend that, number one, you practice. Like, it's hard to just see a tree for the first time and riff on it, right? 10 minutes for a grade. It's 10% of your semester grade. But the other thing is, when you're practicing, this is what I recommend the rest of your team members do that are listening to your practice. Close your eyes. Okay? When your team member is going through the presentation, close your eyes and see if you can follow what they say. Okay? Because that's going to be instructive in how I grade. And by the way, that's just a good lesson, not just in this class, but in general. And here's what I mean by that. When you're presenting something that's very data dense, okay, that people usually have seen for the first time, and they don't understand every item on there, and you're trying to explain it to them, it's hard for them to follow what you're saying. But they may not know what you're looking at. And, sorry, I have a little trouble with the projector here. There we go. And without talking about the numbers, it's hard to follow the presentation, right? And here's the reason I also say go in order. So imagine if this was the presentation, okay? So Starbucks ROIC got a lot worse over the last 5 years. You can see that the productivity worsened because the PP&E worsened, but the gross margin got a little worse too, and the operating margin got a little worse, but the tax rate got a little bit better. So therefore, the ROIC went down from 48 to 23. Could you follow that? Exactly. So when you're giving that word salad to me and I'm giving you a terrible grade in your presentation, that would be why. Right? Because I don't know what you're talking about. You're just using these general vague comments. And I don't even know what numbers you're looking at, and it's really hard to follow. And I'm just telling you, just even in your professional life, that's why using numbers can be very helpful, because people can kind of follow exactly where you are on the slide. Laser pointers can be helpful too, but just using numbers gives you credibility, helps people understand what you're talking about. When you refer to things, you're explaining why things are changing, as opposed to making general things. Like, it may make sense to you in your mind, but you got to communicate to the people that are in your audience. So that's the way we're going to be grading this. That's why it's important to use numbers, follow the process, walk through, talk about how something is making the driver above better or worse, and connect some dots. If your goal is just to read a bunch of numbers, you're not going to do well. Because I know you can read numbers. You tell me what they mean. That's your assignment. All right, statement number 2, CFI. We have converted the CFIs. Okay, and we know there are 4 sections of the CFI. When you do a CFI analysis, you explain all 4 sections. Section 1 is operating. What's happening with the operating cash flow of a firm? Section 2, you got to explain what's happening with the non-operating cash flow. Section 3, you got to explain what's happening with the debt cash flows. Section 4, you got to explain what's happening with the equity cash flows. Just like the ROIC tree, you have to cover all of the sections using numbers. right? Now on the CFI, I have a sixth column, 5 years of historical data. The sixth column is called the total, right? It literally just sums up the other 5 years, okay? Because it's kind of a summary of the 5 years. So we're going to focus on the total, but as I said, you're eventually responsible for the years in between and the trends, okay? When you do a free cash flow analysis, you always start, or CFI analysis, you always start with free cash flow. You always start here, okay? And by the way, that number is going to be telling, okay? So if a company's free cash flow is positive, you're going to explain why it's positive, and then the focus of your analysis is what did they do with the money. If a company's free cash flow is negative, you're going to explain why it's negative and where did the money come from to fund the loss, okay? So that's why it's a very important starting point, because it kind of frames everything else that you're going to be doing. All right. So let's start with Starbucks. Total. Over the 5 years, Starbucks generated $3.2 billion of free cash flow using the total column. Okay. They generated $20.99 billion of gross cash flow for the income statement. They reinvested $15.96 billion into the balance sheet. That gave them $5 billion of free cash flow before goodwill. That represented a 76% average reinvestment rate over the 5 years. They spent about $1.8 billion of investments in goodwill and intangibles, mostly in 2018 when they spent $2.6 billion. And at this point, I would tell you, if this were my project, who they bought, giving them $3.2 billion of overall free cash flow from operations. The other number that you'll talk about is the CapEx to depreciation ratio. Okay, so the overall investment was 76%, but I want to focus on CapEx to depreciation. Depreciation is supposed to represent, it's kind of arbitrary because it's usually straight line, but the percentage of an asset that's wearing out over time. So if I have a 10-year life, then 10% of the asset wears out every year. Okay, it's kind of a rule of thumb, but here's another rule of thumb. If 10% of my asset is wearing out every year, then I have to spend 10% of its assets value to maintain what I got. So basically, spending depreciation maintains the current assets. It's an assumption we make. It's not always true, but it's just an assumption that we make. Okay? So if that's the assumption, why would a company spend more than depreciation? Why would a company spend more on CapEx than depreciation? What would the goal be? What would be a reason to spend more than depreciation on CapEx? Why would you do that? Because if I spend my depreciation, I got enough to basically sell what I need. I don't need to do anything else. Why would I spend more? Why would I increase my capacity? Yeah. It's a growth signal. So generally, when you spend more than CapEx on depreciation, you're signaling you want to grow. So this is a short-term growth indicator, next 12 to 18 months for most companies. And if they're spending a lot more than CapEx on depreciation, they're kind of telling you, I expect to sell more because I don't have enough to go around and I got to build something. Why would a company spend substantially less than its depreciation on CapEx? Wouldn't the opposite be true? Like they don't expect to grow. Right? And if I kind of maintain what I have, I maintain it. Over 5 years, Starbucks CapEx depreciation ratio averaged 247%. This is a growth story over the last 5 years. They were trying to expand, clearly. But here's what's interesting. In 2021, that number fell to 115%. It was the lowest of the 5 years. So as you think about 2022, and you think about forecasting Starbucks, the company is telegraphing, yeah, they expect to open a few more stores, but they're not expecting massive growth. The growth is clearly slowing. Does everybody see how we can interpret that? Okay. But that gets us to the $3.2 billion of free cash flow. Now we go to section number 2, non-operating cash flow. They went from $3.2 billion of free cash flow to $8.5 billion of CFI. So they had about $5 billion of non-operating cash flow. Where did that come from? Well, in Starbucks case, they made $3 billion in non-operating gains on their income statement, most of which occurred in 2018 when they earned $1.6 billion. They earned $6.3 billion selling off non-operating assets. Most of that occurred in 2018 when they could generate $8.5 billion of cash from selling off their non-operating assets. So that's about, round off, 9-ish, 9.5, right, of non-operating cash flow. They then took $4.199 billion, $4.2 billion, and they basically banked it in excess cash. They transferred money to savings. So if you think about $9 billion from the income statement and balance sheet minus about $4 billion into excess cash, that's the increase of CFI of $5 billion to $8.5 billion from this free cash flow. So once we know they have $8.5 billion of free cash flow, or sorry, CFI, what did they do with it? Where'd it go? Okay. So first we're going to look at the debt. Over the 5 years, they paid out $1.176 billion of interest expense, pretty consistently over each of the years. They borrowed $20 billion of new debt, the majority of it in 2020. Here's a midterm exam question. And there's an answer to this, it's correct. Does Starbucks was this necessary to borrow $20 billion worth of debt? Was that a necessary borrowing? Did they need that money? Or could we call that discretionary? There's a correct answer to this, and there's a number that helps you answer that question. Did Starbucks need to borrow this money, the $20 billion of debt? Yeah.
Yes,
Why?
to fund their share repurchase.
That's not where I'm going to get at. Did they need to borrow it in terms of, let me clarify, with their operations? Did they need this to fund their business? Did Starbucks need to borrow $20 billion to fund their business? Yes or no? The answer is no. Why not? What number tells me the answer had to be no? Yeah.
Their cash account.
It's not just they had cash on hand, they had free cash flow of $3.2 billion. So if I generate $3 billion more of cash running my business than I spend, I don't need to borrow to fund my business. And if I generate another $5 billion from non-operating activities, I have $8.5 billion to total cash, I don't need to borrow to fund my operations. So why are they borrowing the $20 billion? I think he was looking ahead. But that's what I want you to keep in the back of your mind. So negative $20 billion of debt. Why? They go into equity. They basically pay dividends of about $9 billion, 7.6. And they bought back $21.5 billion worth of stock. Those two numbers, 21.5 and 9, add up to about $30.5 billion, round off, called $31 billion. So I'm giving $30 billion of cash to my shareholders. Question number 2, can they afford that? Could they afford from operations the ability to give $30 billion to the shareholders? No. How much could they give them? Well, if it's from operations, it's 3.2. Okay? If it includes non-operating activities, 8.5. Both those numbers are well below the 30 that they gave them. Okay? So how do you do this? Well, what is 31 minus 8.5? So why'd they borrow $20 billion worth of debt? There you go. They borrowed the debt to buy back the stock. So don't get me wrong. As an investor, I like cash. Cash is good, right? So they gave me some cash. But here's the point. Is this sustainable? Like if we were to replay another 5 years, can they still buy back and give dividends of $20 billion to the shareholders? Probably not. Because if they don't earn more free cash flow, remember, free cash flow is your theoretical payout rate. If they're reinvesting 70% and they're making 30, what's the reinvestment rate? 76, they're making 24% payout. They can pay out 24%. They can pay out $3 billion. They can't pay out this much money again. They're borrowing the money from the banks to pay off the shareholders. At some point, the banks are going to say, I'm not giving you any more money, because the banks are going to start looking, how do you pay me back? You got to pay me back with that free cash flow. So on the one hand, they can trub it a great press release like, oh, look at all this investment we're making in our company. But the other side is, yeah, but it's not as great as you think. Yes?
Why not pay out within their means? Like, why would they?
That's a great question. Because then the share price might not have been as good. So I want you to understand, and this is another very fundamental question that could be on the midterm. I told you the midterm writes itself. This is one the last class struggled with. Ironically, the 11 a.m. class, they were all over this. They understood it right away. So let's see how you guys do. Why does a company buy back its stock? Right? I want you to think about that. Before you answer, what's the ROI on a stock buyback? What rate of return do you get when you buy back your stock? We'll start there. What's the rate of return on investment of buying back your stock? What's that mean? I saw this. It's like playing the drums. What? What's the answer? You don't have an answer? Does anybody have an answer? What's the rate of return? You're going to love the midterm. What's the rate of return you get buying back your stock? Yes?
Whatever's the price change in the stock.
No. Good try, but that's actually not the answer. Yes?
The rate of return of the company itself.
Say more. You're getting closer.
Will the companies buy back their own stock or pay money to get their stock?
Okay, so let me help you. Okay, so I don't have a credit card, and I know you can't see this on the video, but on my Apple, I have an Apple Wallet, and this is my Chase Sapphire Reserve credit card on my Apple Wallet. So it's my credit card. Okay, and I like this credit card because it gives you 3% cash back on like food and travel, which you can turn into 5% back when you actually use it for travel. So it's a very high reward card if you travel a lot. Okay, so but here's the point. Okay. It's a bad idea to carry a balance on a credit card these days because you're going to be paying anywhere between 16 and 25% interest per year. Is just very, very high interest rates, but people do, and I think the average American has something like $6,000 of balance on their credit cards today. Okay, so let's just say I'll make up a number. I have a $10,000 balance on this card, so I owe Chase $10,000. My interest rate's actually pretty good. I think it's like 16%. Right. But I say pretty good, that's still pretty high, right? Some people pay this a lot more. But I'll round off and say I pay 16%, right? So here's the point. If I have a $10,000 balance on my card and it has a 16% interest rate attached to it, and I make a payment to the credit card, what's the return on investment of that payment? If I pay off my Chase card, which has a 16% rate of interest, what's my ROI in paying off the Chase card? 16%. Because if I pay them money, I don't owe them 16% anymore. So incrementally, I'm saving the 16%. So I'm getting a 16% return on investment paying my credit card. Does everybody understand that? What's the return on investment when a company pays back its shareholders? Whether it's a dividend or a stock buyback. When I give money to my shareholders, what return am I getting? Yep.
ROIC.
It's not the ROIC. You're close.
Dividend payout ratio.
It's the cost of equity. If my cost of equity is 10%, then buying back the stock basically saves me 10%. So basically, I get my cost of capital if I give money back to an investor. I pay off the debt, save 3 or 4, pay off the equity, save 10-ish, whatever it is for the company. In this example, say I save 10. Does everybody understand that? Yes. Oh. So follow this. What would be the choice that I would make as a company? Yes.
I think like what they're currently doing, like making cost of equity wise, is better than like future growth prospects.
You see my next question. What's the choice between buying back the stock and reinvesting in the business? Because remember, you can do two things with your profit. You can pay it out, buy back the stock, or you can reinvest. When would I want to reinvest? What's my decision point? Yeah.
Growth is greater than the cost of capital.
When I can make more than 10% on my growth, incrementally. So if I can make more than 10%, why would somebody want to buy back the stock? Because think about it. If cost of capital is opportunity cost, And if my shareholders are saying I want 10%, that means I think for this level of risk I can get 10%. So if you give them this money, they're going to be looking for 10% elsewhere. If I'm making 20% right here, why do they want the money back? Like, keep investing. Do you think anybody's clamoring for NVIDIA to start buying back their stock? Right? I mean, NVIDIA, which is basically transporting these chips in friggin' armored cars because they're worth more than gold and they don't have enough of them to go around. Like, you think NVIDIA saying, well, gee, let's not add to our manufacturing capacity to sell more chips. Let's take all that excess cash and let's buy back our stock. Like, no. You do that, they're going to think you're crazy, right? The opposite's true, okay? You run JCPenney, a company that has no reason to exist. Seriously, has anybody been to a JCPenney at all recently? Recently. Have you been to a JCPenney? Is there a reason to even go to that store? Right? And it's nothing against them. Back in the day, there's probably a reason to go there. But today, I can't even think of the last time I've even been to one. Right? And a lot of them are shutting down. Right? So here's the point. If you're making 3%, and you're struggling with your business, you don't have a good market, a good competitive advantage, you're constantly underperforming, why not buy back the stock? Why, think back to our key value drivers. Why do I want to throw good money after bad when I can take your money and make 3%, I can give it back to you, you can go make 10% elsewhere. I don't want to fund that negative growth. I want to disinvest. That's when it makes sense to pay out. Okay? Does it make sense? All right. Now, yes?
Combining two of like the points you've mentioned recently, if their cost of equity is higher than their cost of debt, wouldn't it make sense?
It will always be, by the way. Cost of equity will always be higher than the cost of debt because debt is paid before equity.
So might it not make sense to actually do the $20 billion buyback even if they have to?
Well, I want to come back to Starbucks. So then here's the other thing, and this is the tough part. The key word here is incremental. Okay? So let's say I'm making a good rate of return, but I've run out of things to invest in. So I don't want to marginally throw money at a 20% business that turns it into a 10% business because the people internally can't use it. So I actually want to look at that incremental return on investment. That's what matters here. It's not the total historical return. It's the incremental return. And if I can incrementally use it in the business to do better than my cost of capital, I probably want to reinvest it. If I can't, I probably want to pay it out. And so it's the marginal dollar that matters. Now, going beyond the theory, let's talk about politics. Okay? Over the last 10 or 20 years, most senior leaders, including CEOs, are compensated on stock options, which means higher share prices, and their perceived earnings per share growth. That's what I'm compensated on. So why might I want to buy back stock? Well, if I buy back the stock, there's fewer shares outstanding. And if I make the exact same profit with fewer shares outstanding, magically, earnings per share have grown. And when earnings per share grow, I get a bonus. And oh, by the way, if there's fewer shareholders for the same value, stock price goes up because I have fewer shareholders with a higher price to the same size pie. And so if my stock options are based on share price, not market value, then I can manipulate the gain by buying back stock. It's win-win for the leaders, okay? So when you can't actually drive earnings per share, you buy back your stock to create artificial earnings per share, okay? Which leads to another midterm question. Does buying back stock affect the operating value of the firm? Yes or no? There's an answer to that. You should know this. Does buying back stock affect the operating value of the firm? You're shaking your head. That's the correct answer. The answer is no. Why is it no? Yeah.
The cost of revenue stay the same in the company?
It's not that the cost of revenue stays the same. You're getting closer. Show me on this slide why stock buyback or dividend payments has no impact on operating value. If I buy back $21.5 billion worth of stock, does that change free cash flow? It does not. Stock buybacks, dividend payments, debt issue retirements have zero impact on free cash flow. Therefore, they don't change the value of the company. That's the point. What you're doing is you're changing the capital structure. You're changing how you're slicing and dicing the CFI, all right, and particularly the free cash flow. Who gets more of it, who gets less of it by changing who owns it. But you're not changing the free cash flow itself. Therefore, payments to investors have zero, repeat, zero impact on the value of the firm. It's a misnomer to say otherwise. Now, there could be signaling effects. I'm signaling to you that I'm buying back the stock because I think it's going to go up, right? I'm signaling that I think that the company's undervalued. I'm signaling that I want to make a big bonus and my earnings per share need to go up and the company's actually not going to grow its earnings, so I'm going to actually reduce the share count. I won't say that publicly. Instead, I'll say I'm investing in the future of the company. But if you're investing in the future of the company, you'd invest in CapEx. You'd invest in working capital. You'd invest in R&D. You'd be hiring staff. That's investment. If you're paying it out, that's not investment. You're returning cash to the investor. And so again, the incremental decision on returning cash should be, what can I do with my incremental dollar? Then, a second question, assuming I can't do it and I'm paying it out, how do I pay it out? Okay? There could be more tax efficient ways to pay it out. That will affect some of the value, but it won't change the operating value. And that's important to understand. Questions? I just gave you 3 midterm questions there. All right, so that was Starbucks. So 20 billion of debt, and we showed all the equity payments, and we explained why this is A, not sustainable, and B, why this was purely discretionary. Let's do another company. Target. Okay. Also, I think you guys sometimes call them Target. But over 5 years, 2017 to 2021, their after-tax ROIC went from 13.5 to 20.5. Tax rate. It also benefited them going from 32.7 to 21.2 over the 5 years. There was a 35% drop in the tax rate, most of it occurring between 2017 and 2018, when it went from 32.7 to 19.9. But overall, that drop in tax rate benefited their ROIC and is one of the reasons why it went up. Okay? But the underlying business itself, the pre-tax ROIC, also went up from 20 to 26. That was a 29.9% change in pre-tax ROIC. Okay. Driver number 2, operating margin. In 2017, they made 7.2 cents. In 2021, 7 cents. Virtually unchanged. Slightly worse, 0.002 worse, but I'd call that pretty much unchanged. Now, it did dip in 2020 to 6% and 2019 to 5.5%, but it recovered to 7% in 2021. Driver number 3, invested capital to sales. In 2017, they were spending 35.7 cents IC to sales. In 2021, 26.8. Most of that improvement occurring between 2020 and 2021. That 25% drop in invested capital to sales was the reason the pre-tax ROIC went better from 20 to 26. Okay, so 2 of the 3 drivers were favorable. Productivity got a lot better, and tax rates got a lot lower. But that was offset, or at least mitigated, by the fact that the margin didn't really change. Okay, that's your first level analysis, using numbers that you would have to do. Questions about that? All right, now we're going to click down. Even though the operating margin didn't change, 7 to 7.2, let's see what happened in the gross margin. On the income statement, gross margin went from 32.6 to 31.9. That's a 0.07 cent drop in gross margin. Lower gross margin is actually hurting their profitability. SG&A went from 22.1 to 22.3. Virtually unchanged, but a 0.002 increase in SG&A. And depreciation went from 3.3 to 2.7. That's a 0.06 improvement in depreciation. So if I think about it, why did the operating margin for Target change? Well, depreciation and SG&A kind of offset each other. And really, it was a drop in gross margin and some benefit, the offset of depreciation of SG&A, that basically led to the slight drop in operating margin. So their gross margin actually did get worse. Why did the productivity get worse? Invested capital sales. Well, they went from 0 working capital in 2017 to negative 5 cents in 2021. When you go to more negatives, we talked about last week, that is a big savings in working capital. There's 5 cents of improvement right there. in invested capital, excuse me. PP&E to sales went from 35.5 to 31.1. They saved 4 cents there, 4.4 cents. So they saved 9.4 cents in working capital and PP&E. That's why the invested capital sales went down. Intangibles basically went from 0 to 0. They don't really do acquisitions, not historically. So once I've identified those, I summarize right to left. So the summary of target is a savings in working capital and PP&E, 9 cents together, led to a drop in invested capital sales from 35.7 to 26.8. With flat operating margins led to an increase in the pre-tax ROIC from 20 to 26. And that combined with a slight lowering of tax rate from 33 to 21 led to the overall ROIC going from 13.5 to 20.5. So go through left to right, cover every item of the tree, talk about whether it's favorable or unfavorable to the item above, and then summarize the overall impacts on the ROIC. That's your other half of the assignment that you're going to go through. Questions? And again, if something happens in an intermediate year that's a big change, highlight it. So for example, 2017 to 2018, there was a big drop in operating margin. Okay, why? What made that year the outlier? Why did it change? That's where the real world context might come in. Or as I said, if you see a big jump in intangibles, signals probably an acquisition was made. Who did they buy? How did that change their business? Statement number 2, CFI. Again, 4 sections, starting with free cash flow. For Target, their free cash flow, $18.9 billion of positive free cash flow over the 5 years. Okay, most of it, $7 billion, generated in 2021. That was the biggest year for free cash flow. They generated $31 billion of gross cash flow. They reinvested $11.8 billion of gross investment. They averaged a 38% reinvestment rate. Now, what's interesting is the reinvestment rate peaked in 2019 at 61% when they invested $3.5 billion of CapEx because they didn't save a lot in working capital, which they did in 2018. But overall, they spent on CapEx anywhere between $2 and $4 billion a year for each of the 5 years. Their CapEx depreciation ratio averaged 132%, again peaking in 2018 at 171%. But even in 2021, it's a little bit below their 5-year average for CapEx depreciation, but they're still signaling some growth in 2022 based on their 2020 results. Okay. What did they do with their $18.9 billion of free cash flow? Well, $4 billion went into non-operating items, giving them $15 billion of CFI. What happened to the non-operating cash flow? Primarily, they increased their excess cash balance by $4 billion. The majority of it occurring in 2021 when it increased by $5.6 billion. Okay, so I took $19 billion of free cash flow, rounding off to $15 billion of CFI because I put $4 billion into excess cash. Right? What happened to the rest of the $15 billion of CFI? On a debt standpoint, $2.7 billion of interest. They issued $2.3 billion of new debt, most of it in 2020 and 2021. Again, that should be a little bit of a flag there. This is discretionary. They don't need to borrow debt. They got $19 billion worth of free cash flow. Why are they borrowing this debt? $6.69 billion of dividends, $9.2 billion of share repurchase. That's about $16 billion. How do you buy back $16 billion of equity, dividends and share repurchase, if you got $15 billion of CFI? There's your debt. Okay? So, again, a lot of companies took advantage of this, right? Including Starbucks, which is, there's another reason. Over that period of time, we were at the lowest interest rates ever. Right? Artificially low, you could borrow at like 2 or 3%. I'm a CFO. My cost of debt's 3%. My cost of equity is 10%. Why not load up on the debt to buy back the stock? Right? A lot of people did this. Right? Also reduces the earnings or reduces the share count, increases the earnings per share, might use the stock price in the short term. But basically, the banks were willing to do it, and companies took advantage of it. Right? Target, not as much as Starbucks. Right? But here's the thing. How much cash is Target giving to its shareholders over the 5 years? What's the number again? How much cash over the 5 years is Target giving to its shareholders? Dividends and stock repurchase combined. What's that number, approximately? Yeah,
Did you say over the total of like
Total,
5 years?
yeah, over 5 years.
Like 6,694.
plus the 9186 together. It's about 15, 16 billion, we said? All right. Is that sustainable? Like if these next 5 years were to repeat, could they afford it? How do you know? Yeah.
They're having to borrow.
No. Yeah.
Free cash flows was about 19 billion.
Yeah, they got 19 billion of free cash flow. So paying out 16 billion to shareholders, they can do that. Can Starbucks afford to repay with 3 billion of free cash flow 20 odd billion to the shareholders? No, they cannot. So the thing again, cash is cash, but as I look at Target stock buyback, this is actually a more sustainable return of cash to shareholders than Starbucks. They both return a lot of cash to shareholders, but unless Starbucks loads up on more debt and the banks are willing to let them do it, they can't really do it from operations. They can't repeat that. Target can. And they can afford, with the money left, to fund their CapEx. So I'm just saying, like, this is a better story financially if you're talking about sustaining a payout than the Starbucks payout. Does everybody see that? I'm just telling you, now that we're in this format, things become a lot more clear. Much more clear than even the companies sometimes understand what they're doing. All right, questions? So as I said, 250 words minimum. Think about this. On the ROIC tree, walking through, about 250 words on the CFI, highlight the totals here, any interesting changes in between, bring it into a real world context. Not gonna have any trouble with 500 words. Okay, you're gonna have 2 assignments next week, one due Monday, one due Wednesday. I'll give you both companies today. Okay? And in 2 weeks, you're gonna be presenting this for a grade. Okay? All right, company number 3. So back to this. Let's go to another company, Dollar General, another peer in the industry. I'm going to give you about a minute or two to look at this. And I want somebody to help me think through how we would explain the Dollar General 5-year change in ROIC. Okay? So starting with the 16 in 2017, why did it go to 11.6 in 2021? Right? And by the way, I'm going to make one more comment as you're looking at this data. Forgot to mention this on Target. Notice the intangibles in the ROIC tree for Target went from 0.004 to 0.007, but that was a 91.6% change. Right? So be careful about percentage changes. Like a big percent change in a trivial number is not how to analyze this tree. They're there more for a guide. Okay? Versus the 2% change in gross margin from 32.6 to 31.9, because it's a much bigger number, that smaller percent change had a bigger impact on what happened with Target than that gigantic change in the lint in your dryer of the intangibles to sales. Okay? So just be careful about percentage changes when you go through this analysis. So don't build your entire analysis on percentage change. All right, so again, look at Dollar General for a minute, and then we're going to start talking about the drivers. Start with the first level in a second. All right, so where do we start with the ROIC? What's the first number we should start explaining? Yep.
The tax rate.
Okay, so what happened to the tax rate?
It went up a little bit, but stayed relatively stable from 19.
All right, if my eyes were closed,
Oh, it went up a little bit from 19.3 to 21.7%. So
Okay.
that's an approximate change of 2.4%, whereas the ROIC dropped comparably more.
so hold on. The tax rate going from 19.3 to 21.7, what was the impact on the after-tax ROIC? Did it help it go up or did it hurt it go down?
It would hurt it a little bit, but not as much as.
But I'm saying, so the ROIC for Dollar General went from 16 to 11.6 overall. So one of the reasons it went down is the tax rate got worse. So I want you to make sure you say those things too. Just don't say, oh, tax rate got better. Okay, so what does that mean? Everybody see the difference? Okay, so he was directionally correct, but I want you to be more specific as you go through this. Now, what about the pre-tax ROIC? Was tax rate the only reason that the after-tax fell? The pre-tax went from, what was it, 19.8 to 14.8? Why did the underlying business get worse? Now you can say what you said. Why did the pre-tax get worse?
It looks like invested capital over sales went up by approximately 0.2 from 4.31 to 0.638, while the operating margin also increased from 0.086 to 0.094. So to me, it looks like they increased their invested capital for some reason, while sales didn't increase by the same percentage.
Which meant,
Oh, they were spending more to generate every dollar of sale.
and that impacted, tie it back to the one above. That's why the ROIC went down. The pre-tax ROIC went down. They're spending more to generate sales. They went from, as he said, 43.1 to 63.8. That 48 percentage change in investment per dollar of sales drove the pre-tax ROIC down. In fact, it's the whole reason the pre-tax ROIC went down, because they're making more in every sale. Their operating margin actually went up, which should have helped the pre-tax ROIC. So the reason Dollar General's pre-tax ROIC went down, productivity. But that was benefited, pre-tax ROIC, by an increase in operating margin, which went from 8.6 to 9.4. Why, second level analysis, is Dollar General making more profit when they sell a product? What's causing the operating margin to go from 8.6 to 9.4? What's next? Yep. Oh, over here.
It increased the gross margin from 0.325 to 0.335,
Which did what to operating margin?
which made it increase from 0.86 to 0.86.
So that's one of the reasons the operating margin went up, the gross margin increased. All right, what about the SG&A?
It stayed the same from 2017 to 21 to 0.222.
So that didn't really affect the operating margin. And what happened to depreciation?
And depreciation went up from 0.017 to 0.019.
Did that meaningfully hurt the operating margin?
No,
So the operating margin clearly went up because
gross margin.
it's all gross margin. The 32.5 to 33.5. The 1 point of gross margin explained the essentially 0.08 points, the 0.8 points of operating margin. Productivity. Why did the productivity get worse? Why did it go from 43 to 64? Was it working capital? Is working capital favorable or unfavorable to productivity over the 5 years? Went from what to what? What's my from to?
0.08 to 0.054.
Is that getting better or worse? Is that more favorable or less favorable to productivity? That's favorable. So they got 3 cents of savings from working capital. That's favorable. What about PP&E to sales? Went from 2 from what? Yeah,
0.115 to 0.422.
that's a big jump, right? Yeah, so that's the real hammer to the productivity, spending a whole lot more opening up a bunch of stores. And that's been the contextual story of Dollar General. They've been expanding across the country, opening up a lot of Dollar General stores over the last few years. And you see that here in the ROIC trade. Okay, and there's a bit of a lag, because when I open a store, you know, it's not like I say I'm gonna spend money and then a month later the store magically appears and everybody's selling stuff out of it. Like, it's gonna take a while to build the stores. It's gonna take a while for the customers to show up and get to, you know, the sales of an existing store. That could take a year and a half. So there might be a little bit of a lag on spending, which is probably why some of these numbers are going up. If I'm opening up a lot of stores, there's a sales lag, my productivity is gonna get worse. So if I'm forecasting out over the next 5 years, how do I know if Dollar General is successful with their expansion? What would I expect to happen? What should happen over time? Yeah,
PP to sales should go back down.
absolutely. And if PP sales is starting to trend down, then I'm starting to see improvement on same-store sales. If I'm not, then they open up a lot of stores and they were just cannibalizing themselves. Okay? Now, next, intangibles to sales went from 23.6 to 16.2. I didn't really see any ups over the 5 years, so therefore it doesn't look like they did any major acquisitions. Okay, so didn't really do a lot of investment in M&A. Right, they got some improvement in working capital, but as I summarize, the primary reason the productivity improved was, or got worse, is the PP&E to sales. Okay, they spent a lot of money on PP&E to sales. That drove the invested capital sales up from 43 to 64. That was not enough to offset the increase in margin in driving the pre-tax ROIC down from 19.8 to 14.8, and coupled with a slight increase in the tax rate, drove the after-tax ROIC from 16 to 11.6. Questions? All right, CFI. Final statement we'll go over today. Again, I'll give you a minute or two to look at it before we fully go through. What's going on with Dollar General CFI? So where are we going to start? What's the number we should be starting with our analysis? Where should your eyes go first? Up this side of the room. I'm going to go that side first. Yes.
Free cash flow,
What number?
total over the 5 years,
Give me the number. Like, what's the number?
negative 1.67 billion.
Okay, so start there. They got negative free cash flow, right? Why do they have negative free cash flow? What was their gross cash flow? Can you read the number? Yeah,
Their gross cash flow was about positive 12 billion.
12.9. I know it's hard to see the numbers. See if I can make it a little bigger. Sorry, there's all sorts of mouse problems today. There we go. See if that helps a little bit. All right, 12.9 billion in gross cash flow. How much do they reinvest?
$14.6 billion.
Giving them how much free cash flow before goodwill?
1.67 billion.
So they spent more than they made, which is the key point. So their reinvestment rate was, what was the reinvestment rate? Yeah, that's them spending more than they did. By the way, which year was the biggest amount of reinvestment?
2019.
Yeah. Why that year? Back to outliers. Here's a big outlier. What happened in 2019 that caused them to spend that much money on CapEx? That's something we could research. Because that was pre-pandemic. CapEx depreciation ratio averaged 566% over the 5 years. They're clearly in growth mode. Now, ironically, it started to slow in 2021 to only 266%, right? So still growing, not as fast, but still growing pretty substantially based on that number, expecting to grow, okay? So negative 1.7 billion of free cash flow turned into negative 1.5 billion of CFI. A couple trivial things happened there, but not much. All right, they decreased their excess cash by 88 million, and they sold off 65 million in non-operating assets, but they still had negative 1.5 billion of CFI. How did they fund that deficit? I'm $1.5 billion short. Where'd it come from? Debt. How much debt did they increase? New debt was how much? 11 billion. I need 2, let's go borrow 11. Right? Now I did need some money to pay off the interest. I needed 476 to pay off the interest. So I'm at 1.7 and call it 5. I need 2.2 billion. That seems like 10, 11 is a lot bigger number. Why'd they borrow 11? Because they paid out $1.7 billion in dividends, pretty consistent over the 5 years. But 7.8 billion in stock repurchase. So here's another example of a company that borrowed debt to fund a share repurchase. Okay? While simultaneously investing in new stores. Now, for them, it's a little bit trickier because when did they borrow most of the debt? What year?
2019.
And that was how much debt? 8 billion and change. And what did they also do in 2019? That was the CapEx of 9 billion and change. So it could be that they actually did have to borrow to fund some of their store growth. And then the next couple of years when they're generating cash, they basically, instead of paying off the debt, they used it to reward their shareholders. Because if you look at the stock buybacks, they kind of ramped up in 2020 and 2021 to 2.5 billion each year. Okay, so 5 billion of that 7 billion of stock buyback were after they did the big first round of store expansions. Okay, but nonetheless, slightly different story than Target, meaning they're kind of betting on the come. They're betting on the profitability for the store growth before they've actually gotten the profitability of the store growth. Okay, versus Starbucks, which is basically paying out a lot of money, and they're probably not going to see a substantial change in their business going forward. So they're just basically borrowing money to basically take advantage of the debt from the banks, versus Target, which is actually doing the most balanced approach to shareholder payout of the three. Okay, but nonetheless, ROIC tree, CFI. Questions? Okay, so as I said, going forward, there is no class on Monday. Don't pack up yet. There's no class on Monday, Wednesday, right? Our next class Monday, right? On Monday, 10 a.m., will basically be the first homework on the first ROIC tree CFI. The Wednesday will be the second homework, second ROIC CFI. I'm giving you both assignments later today, so just check on Elms when the date is there. And then 500-word minimum write-ups. Make sure you do the minimum words. Make sure that you write it up, okay, based on the data that I give you. So you don't have to convert these statements. I'll give you trees and CFIs that look something like this for real companies, by the way, with the most current data. You won't be doing historical data, okay? That's your next 2 homework assignments. In 2 weeks from Wednesday, you'll be making your team presentations on a company that I'll probably give you next Monday, okay? And that'll be a 10-minute presentation walking through all this stuff. Yes, sir.
When did you say the midterm was going to be?
The midterm is next Wednesday.
Okay.
And then, did everybody sign the sign-in sheet? Make sure you sign before, don't leave yet. Okay, hold on.